Nothing you see in this video is financial advice. I'm not a financial advisor. I'm just a random guy on YouTube. Today, we're going to go over my covered call on Celsius Holdings. I'm going to show you guys how I'm managing the position that is up, which means the stock price went down a little bit, but that's super okay. Now, something that helped me in the beginning to learn more about selling puts, selling covered calls, the wheel strategy, option trading, was just watching a lot of people on YouTube do trades, manage trades, sell options, buy options, understand mechanics, right? So we're just going to go over and I'm going to show you guys how I'm managing. Now, this is a $40 call. Now, I'm bullish on Celsius Holdings, okay? So this is a moderately bullish strategy. And as you can see here, I have 4 contracts with a $40 strike price. Earnings are this week, okay? So now the contract itself is up 80%, and there's still 3 weeks to go, right? So there's only a limited amount more that I can capture. And basically, there's going to be more volatility, more things happening with earnings. It could pop up like crazy. But let's say the stock, I'm super bullish on it. So no matter what happens in the short term, I'm bullish. I really actually want to own the shares, which is why I went conservative. But let's say the stock pops to like 35, for example, or anywhere above between this current price of like $28 and $40, right? If it pops up after earnings, something. Now, the earnings are going to be, at the time of recording this video, it's in a couple days, in 2 days. Now, I want to be in a position where if the stock goes up, I can then sell another covered call and have better premium, right? So I'm taking a little bit of a calculated risk by closing this position, freeing up the shares to be able to sell another contract later or just hold the shares if I want. But the point is there's limited upside right now, and I want to basically just lock it in, okay? Okay. So what I'm going to do is I'm going to do that for all my contracts, so which is 4 of them. The current bid ask is 9 cents and 11 cents. Very tight bid ask spread. So I'm going to go right in the middle at 10 cents. That should fill. So the cost of this is going to be $40. And I gained, selling the contract, $154 total, up 80% on the contract that I sold. Now the expiration 8/21, so yeah, a few weeks left. And yeah, pretty much right before I execute this contract, I just want to show you on Robinhood, it's really, they make it very simple, very easy to see what happens, or basically how the contract behaves, depending on what price it is, right? So if the contract were to go lower, let's say I go lower in price. So the contract, it's not going to move too much because there's only a limited amount that I can get. I'm capped at $194 total dollars I'll gain, and it's already down a lot. So this will, as the price goes lower, it's not going to move that much. So, and if the price goes higher, you're right, this contract in the short term will lose that value. So I'm going to be stuck with it until I get closer to the expiration date, right? So even if it expires at, let's say, $37, which is under my $40 strike price, I'm going to be down on the position. But as I get closer to expiration, I'll realize that 194, as long as it expires under 40. So I want that freedom, right? Okay. So that being said, let's go back here. I'm going to do the 4 contracts. It's still 10 cents. I'm going to, it's buy to close because when I sold it, I sold to open. So we're going to submit that. I'm paying $40. Boom, it filled. It's great. Now I have my 400 shares because each contract is 100 shares worth, right? So now I don't have that $40 call anymore. Now I also have a $37.50 call at $21. Let's see how much upside I have left. So this is already up 75%. It's up $65. if it wasn't earnings, I don't know, I might just let it run, but there's going to be some extra volatility, and I just want the option free for, after earnings. So, we'll reassess what happens when we have more information. So, bid ask spread, 19 and 21 cents. I only have one contract here. So, one contract, correct? Yep, one contract. We'll set it for 20. And yeah, usually you want to go right in the middle of that bid ask spread. Otherwise, it'll usually fail for the higher price. Okay, so let's see if it fills. Okay, the bid ask right now is 20 and 22. So what I'm going to do is I'm going to replace. Continue. Yeah, the bid ask, it looks like it's because let's try 20 again. It's because it's a 37.50, which basically the volume, there's not as much liquidity as if it's on the like a 40 or a 35, right? It's not an even number, so there's not as much liquidity. So that's why it's not filling at that middle price, most likely. So we'll end up having to go on the high end of the bid ask, but good thing it's tight. It's only 2-cent difference. So we're gonna buy to close, 21 bucks. And that filled. Yep, not a lot of volume. 12. If you see that volume, it's only 12. Okay, so that's done. So we're closing out those covered calls. Spent about 60 bucks closing those out. We have a $35 put on Celsius so far, and yeah, so we're not going to touch that. Celsius, we're also not going to touch these. We're just going to let these ride because these are not 75% up. These are just, these are actually down in the position because the stock rose a lot after selling those covered calls. So that's basically it on the Celsius covered calls. I have some other holdings right now. There's a lot of earnings this week. At the time of recording this video, AMD, SoFi just had their earnings. The stock is up. We'll talk about those another day. But yeah, let me know if this helped you, just seeing how I thought about the covered call and also just managing it. Let me know if you have any questions in the comments, and we'll see you in another video. All right, peace.